Hello, it's Mr. Intermarket Analysis. I'm just bringing you the video of the S&P 500. I'm just going to review this and try and forecast exactly what's going to, or what I expect to happen basically over the next few hours. So we have the S&P 500 daily chart here. You can clearly see it's has a rising contracting wedge pattern, which according to technical analysis is considered to be a potential bearish pattern as it eventually breaks southwards. As you can see here, we were in a bullish channel. We've broken out above the bullish channel, mainly due to constant short squeezes, obviously anticipation of QE, cheaper money, given that the US data is exceptionally weak. Okay, obviously post debt ceiling, we've obviously rallied higher as well. Obviously the fact that we've had no tapering will be delayed. So again, cheap money policy, markets making new highs. It is consolidating above the last pivot resistance. We've got a resistance level there, which is obviously is holding above that, and also holding above the previous diagonal trendline resistance as well. But the slight problem that we have here, well, not slight, quite a major fault really, is the fact that it's not in concert with the Shanghai index. As you can see, the Shanghai index has already broken south and of this bullish channel, and Shanghai tends to be the global leader. So whichever way Shanghai tends to go, global markets have a tendency to follow. Given the fact that we've got a lot of debt concerns rising in China now, obviously the fact that the stimulus is going to be halted, given that the Chinese data was relatively not upbeat, but came in line with expectations or slightly higher. So obviously there will be no cheap money policy there. So hence the reason why it's breaking to the south. Okay, so let's go back to our S&P 500 here. Bearing in mind, obviously China is down. Obviously, therefore, we expect the S&P to come under pressure as well. Cheap money or no cheap money, either way, it has to fall in line with global markets. Now, with regards to the S&P 500, we can clearly see here on the 10-minute chart, you've got a bullish channel, which is continuing at the moment. I expect this bullish channel to eventually break to the downside. We've got a gap. Obviously, we've got an unfilled gap here at around the 1754 level. Okay, we are making a potential lower high for a right shoulder, which is quite important. If we go to a 60-minute chart, we'll get a slightly better angle at this. Okay, so we've had a bullish contracting, well, a rising contracting wedge, which eventually we've broken out. We've broken out the key trend line. We have several gaps below. We've got the first gap here that needs to be unfilled gap that needs to be closed around the 1730 level. We've got an unfilled gap that needs to close around the 1700 level, and then we've got a gap that needs to be filled below at a 1650 level. So gaps or unfilled gaps that are left behind are not healthy for the market, and generally tend to indicate weakness, as price action is attracted to it like a magnet. Now we are potentially creating a right shoulder here. Now if we just use our Fibonacci retrace, take it from the head, take it to the right shoulder, and the market is being obedient in terms of technical analysis. We are below the 61%. Obviously you've got the gap fill resistance at 617.54. You've got a potential left shoulder already formed. You've got the neckline at 1740. You've got the actual head around the 1760 level, therefore 1760 minus 1740, you've got a projection around the 1720 level, which again, which is a first gap around the 1730 level. So you've got a downside target based on this H&S formation going forward around the 1720 region, and obviously we've got this 200 MA below here, and on an unfilled gap around the 1700 level that opens up as well. Now, given the fact that Shanghai was weaker and already broken its channel to the downside, obviously given the fact that the Nasdaq is into resistance, the Dow has its own H&S formation, and the economic data that came out today was exceptionally weak, and obviously NFP data was very, very weak as well, and the fact that QE1, QE2, QE3 is a failed policy, and as Einstein said, if you continue to do the same thing over and over again, it's the definition of insanity. So we are obviously going to pay for that. So the fact that we've got a lot of commodities and risk FX vulnerable as well, with the Aussie obviously down overnight, the Kiwi dollar down overnight, and we've got a potential H&S formation forming on the S&P. The head's in, the neckline is at 1740. We're creating a right shoulder which is below the 61% retrace, and we're looking for a target around the 1720 level below. Okay, thank you very much. Goodbye now.